You're tuned to More Living with Jim Brogan, broadcasted live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for almost 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, folks, because More Living with Jim Brogan starts now.
Hello, East Tennessee, and welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and today, inflation is on our agenda. Inflation has really been a major headline the last 18 months as market participants digested the unprecedented government response to COVID-19, the pandemic, with easy money policy. And since early 2021, the Federal Reserve, has championed that inflation would be, quote, transitory, end quote, or temporary, although following the higher than expected October numbers on the CPI index, consumer prices, the narrative has begun to shift. Fed Chairman Jerome Powell amended his definition of transitory and changed his tune to say that inflation is probably transitory. And he changed the definition of transitory. Thus far, inflation has proven not to be temporary, and further rising prices have quickly become a big problem. And while inflation is a concern, the media is really running rampant with stories on how prices are increasing. So I think it's important to take a step back, look at what's going on, what's likely to continue. Is inflation here to stay? What does that really mean? Does that mean 6 to 12 months? Does that mean several years? And as I've been discussing for really months, what about the long-term implications of how we have printed money and provided easy money policy, kept interest rates a little artificially low, and how do you unwind all that, and what are the long-term implications? Today, I'm really privileged to have on Billy Carroll. Billy is the president and chief executive officer of Smart Bank. He's a University of Tennessee graduate. He also formerly served on the board of the Federal Reserve Bank Nashville branch. Good morning, Billy. It's great to have you back on with us this morning.
Hey, Jim. How are you today?
I'm doing great. How about you?
Doing great. Had a great Thanksgiving. Hope you and your family did as well.
We did. I ate a little bit too much, but I've got to spend the next couple of days kind of fasting a little bit, I think.
You and me both.
So let's digest a little bit. Let's start with the Fed's Jerome Powell saying that inflation now is probably transitory. And he's kind of redefined what transitory means. So talk from your perspective, Billy, of what you've seen over the last month or two and how the narrative has started to change. And are you concerned about inflation lasting a while?
Yeah, and it's a great question. It's probably one of the biggest debates, Jim, that we're seeing, kind of in our world, in the banking world. When you look at the debate, kind of permanent versus transitory or temporary, I think, you've got really smart economists on both sides of this thing. And, I think the majority of them are continuing to lean that it is a temporary situation. I was looking at a survey the other day. I think B of A Securities put out a survey, and they were looking at, I think it was 65-35. That of some of the top economists in the world were discussing this, and I tend to agree with that. I think it is more temporary. One of the things I was looking at, we follow. As I know you do in your business, kind of what's going on with CPI. And, when you look at at CPI and where it is today, there are really only two categories in what makes up our consumer price index that have really spiked, and that's transportation commodities and energy. You take those two components out of the equation, we don't have a lot of other inflation. When we all see it, used car and truck prices are up a ton year over year. Gas prices are up 40+% year over year. Car and truck rentals are up, I think, over 40% year over year. So I think if you normalize just the transportation component of the CPI and the energy component of the CPI, I think this thing settles back down a little bit to where it looks a lot more reasonable. I was looking at something that one of the companies that we do some work with was circulating the other day, and it was they basically said if you just normalized those two components, then you're looking at a 2.8% year over year increase in CPI versus a 5.5% increase year over year with them. Now those two components are big pieces of the economy, but yeah, I'm kind of the mindset that will subside as we get into 2022, and that maybe inflation won't be as rampant. Your opening comments are spot on. There was a lot of money that was injected into the system over the course of the last couple of years, and that in itself is going to continue to take a while to work through. So it's one of those situations. I don't think any of us really know exactly how this is going to play out, but I'm in the camp that that inflation will be probably a more temporary than permanent.
Well, and if we go back, Billy, to our kind of economics 101, when you look at supply and demand, I mean, you've got, with all the free money that's been injected into the economy, we have tremendous demand. The savings rates are up dramatically in the United States. And so we have this pent-up demand. People are looking to spend money, and the supply is just not there. And so when the demand tremendously exceeds the supply, prices go up, right? So it's kind of a good economics 101 lesson. I do want to mention, back in August, Chairman Powell, he pointed to 5 inflation benchmarks when he spoke at Jackson Hole. And one of them was that inflation would not be broad-based, kind of what you were saying. It's kind of isolated to things like energy, transportation, commodities, things like that. But we are seeing some other categories creep up a little bit. Things like, certainly at the grocery store, I think people are feeling the pinch a little bit. I mean, what do you think? Do you think that's what's led him to redefine what transitory means?
I do. I do. I think he's, and I know just from the great opportunity that I had to sit around a couple of those tables at the regional level with the Federal Reserve. Yeah, they are very data driven, and so they're looking at these CPI categories, and they are. And when you drill down into them, they're like you mentioned, food is up a little bit more. I think food's trending up in the 4s. I think 4.5% year over year, which is a little heavier. But I think they're looking at those individual sectors, and I know he's zeroing in on these 2 or 3 that are higher than they should be. And I think that's the reason, if I were to guess, that would be the reason that he's making the comments. Yeah, I do think, you've got so many different situations today just with shipping. We deal with a number of transportation companies throughout our bank's footprint. And, gosh, just the cost to get goods, from one point to another, I mean, it's just tremendously higher. Now, some of those things, I think you're right. Some of those things are going to stay out there for a while. I think wage inflation wages are moving up, and I think that's here to stay. I do think transportation costs. I think some of those are going to continue to stay elevated. So I don't think we're going to be in a spot where you're going to see this thing really go back back to pre-pandemic levels, but I do think it will settle down.
Yeah, the wage pressure was something I wanted to ask you about or to talk about a little bit, because with the wage pressures and the challenges in the workforce, and you say you think it's here to stay, I mean, ultimately corporations are going to have to pass those costs through, right?
Mm-hmm.
I mean, if they want to maintain their margins, then they ultimately that's going to get passed through, do you think?
Yeah, it will. It will. And I think you'll also see companies I think they're going to absorb where they can. I think you'll see companies trying to operate on probably a little bit thinner margins. Jim, I think you know as well as I do, our economy is changing at such a rapid pace. It is moving from a more manufacturing-driven economy like it was back 20 years ago now to more of a knowledge-based economy, and with a big focus on tech. I know in our company, our investments as we grow are a lot of them around technology components that make us more efficient, that reduce our need to have to hire more people in certain spots. And so I think you'll see more investment there. I think wages are going to go up. I think margins in the business world are going to continue to get a little bit tighter. Some of that will get passed on to consumers. There's no doubt about it. But I also think you'll see companies trying to figure out ways to operate more efficiently too.
Yeah, and that's one of the great things about American ingenuity, and that's one of the great things we've always seen historically is when we have economic challenges like this, businesses learn to become more lean and more efficient so they can kind of absorb some of these things we're talking about. That's exactly right. We're visiting with Billy Carroll. He is the President and Chief Executive Officer at Smart Bank. He previously served on the board of the Federal Reserve Bank, the Nashville branch. And when we come back, we're going to talk more about interest rates and Federal Reserve policy, how that affects you and me. There have been a lot going on with the Federal Reserve just in the last week, and there's going to be a lot going on in the next couple of weeks. And then a little bit later in the show, I've got 5 tips of how to beat inflation in 2022 and beyond. So stay with us as we visit with Billy Carroll. You're listening to More Living with Jim Brogan, only on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. We come to you every Saturday, 9 to 10 a.m. and again 3 to 4 p.m. You can catch us online. All of our shows are podcast at broganfinancial.com and click on radio. We're visiting this morning with Billy Carroll. He's President and Chief Executive Officer at Smart Bank. He also previously served on the board of the Federal Reserve Bank Nashville branch. And we're talking about inflation and consumer prices, and certainly has been a lot in the media. And kind of what I got in that first segment, Billy, is that, it's maybe not as bad as it's being made to be. At the same point, one thing I do want to ask you, you mentioned you don't see it necessarily, once we can get through this next 6 or 12 months, you don't necessarily see it going back to pre-pandemic levels. Of course, we were at 1.5% to 2% mostly on inflation, really since 2009 after the Great Recession. Do you think we settle in at 2.5%, 3%? Do you think we're going to have a little bit of a new world of a little bit higher inflation?
I do. I do think we'll have just generally a higher inflationary level. When you can't put as much stimulus into the system like we did over the last couple of years and not have some repercussions from that. So I do think you're going to have a higher than normal inflationary. I just don't think it's going to get back to where it would be what I would call alarming levels. But it's something that that investors need to be aware of. It is you've got to be smart with where you're putting your money today.
Well, and I've heard some people, talking about the late 70s. I think we're probably in agreement. We don't necessarily, at least for now, see that kind of a scenario. Do you agree with that?
100% agree. I think, when you look at rewinding back to the 70s and the 80s. We are a long way away from a CPI number that's up there. We've trended outside of kind of this normal range that we've been in for the last 20 or so years, 30 years. But I do think you'll see this thing settle down. And and over the course of that same period of time, from 1980 till now, you've seen the 10-year Treasury rate. That's a benchmark that I really look at. Now, I look at that 10-year Treasury. That 10-year Treasury has consistently declined since the mid '80s till now. And I mean, it's worked. If you look at a chart, that 10-year Treasury has been in a very, very tight range, decreasing from the mid '80s all the way till now. And so I just don't see it really running outside of that range too much.
Well, and I'm going to tease our audience just a little bit, because in the back half of the show, I'm going to talk about 5 tips for beating inflation as investors and in our financial plans. And I'll just want to throw in there, when the 10-year Treasury has come down the way that it has over the last 40 years, when that happens, bond values increase, because bonds and interest rates, of course, move in an opposite direction. So we've had an historic bull market in the bond market. And but now rates are low. And when rates go up, bond values go down. So I'm just going to kind of throw that in there as a tease for the audience.
Hey Jim, and that's and a plug for Brogan Financial. That's where you really do. You need to align with a great financial advisor, because these times are they're tough for investors, and it's really important. You might need to change your strategy a little bit during a time like this.
Sure, absolutely. Let's talk about the Fed. So the Federal Reserve has, they're cutting back, they're tapering. So basically they've been buying treasuries, and a better way to think about that, I think, for our listeners, is they're printing money or they're putting money into the economy. They're injecting it into the economy. They're slowing down on that. I think they're going to taper that through next summer. So they're starting to tighten up a little bit with their policies. They're worried about inflation. They've been keeping. Do you agree, Billy, with the comment if somebody says that the Fed has kept interest rates artificially low?
Yeah, I don't think it's really tough to argue that too much. I mean, the Fed, has pulled out a number of different ways to help kind of navigate these economic cycles. And, when you're going out and, traditionally the Fed didn't go out and buy bonds. They're going out and they're purchasing securities and then determining at what point to put that back in, to sell those back into the system. So yes, I think it is. It is an artificially low rate environment, no doubt.
Do you think the Fed has been saying interest rates would stay where they are until into 2023? Do you think that is likely to change now with some of the inflationary and price pressures we're seeing?
Yeah, when you look at kind of where rates are, and you look at Fed funds futures or the charts that show you when they think rates are going to come back up, I think it's maybe moved up a little bit. Kind of mid-year 2022 is what has been discussed. I think that's conventional wisdom. Is you'll see the Fed fund rates moving up probably mid-year, and then probably having a couple of rate bumps, pushing the Fed funds rate up, up probably closer to 1% over the course of the next, 12 months or so. But I think the real question, Jim, is what does that do to longer rates? The Fed's going to control the short end of the curve with funds rates, and they attempt to work the longer end too with bond purchases. But if they stop if they stop purchasing securities, which they've telegraphed, and push these rates up, you wonder. My concern is what does it do to the overall yield curve? I think that's where the real debate's going to come. I don't think there's any doubt you'll see short rates up over the course of the next 12 months. but what happens to that 5 to 10 year spot on the curve as you look out.
Well, and actually, just recently, the curve, the 20 to 30 year range got inverted a little bit. So in other words, the 20-year Treasury was paying more than the 30-year Treasury. So out on the long end of that yield curve, there are some concerns, because usually when things get inverted, in other words, when longer term bonds are paying a lower interest rate than shorter term bonds, that often leads to recession. So which kind of leads me to my next question, Billy, is how's the Fed, or just the challenge? Put us a little bit, you served on the Federal Reserve Board with the Nashville branch. Put us a little bit in the minds of the Fed, because they're trying to balance taking some of this easy money policy, trying to kind of pull a little bit of that off the sidelines, slowly increase interest rates. At the same time, they don't want to choke off the economic growth if margins with companies start getting tighter and tighter, because that could lead to recession. So can you just talk about the balancing act here that the Fed is in?
Yeah, and it is challenging. As I said a little bit earlier, they are extremely data driven, but they also, and I think this is the thing that a lot of people don't realize, one of the things that my role as a regional director was to provide more anecdotal information. So, while the data, you look at data and you look at charts and you look at numbers, the Fed also really wants to understand what's going on on Main Street, and so they are looking for real life anecdotal scenarios and hearing, because sometimes the data won't show that. And I do think we're still in such a unusual spot coming out of this pandemic. You have economies like ours here, Jim, in East Tennessee, and a lot of southeastern economies that are running fairly, what I kind of in air quotes, normal. You go to other parts of the country, it doesn't feel like that. As we talk to, I talk to colleagues in different parts of the country, whether it's the West Coast or the Northeast, it still doesn't feel that way. So I think when you look at our national economy as a whole, the Fed's getting this anecdotal information. They're trying to balance what's going on coming out of this pandemic. You've got local and regional, restrictions that are out there that may damper the economy. Fortunately, we've not seen much of that here in our region. But I think the Fed is really trying to balance, the data with what's going on anecdotally, trying to figure out the right way to keep this economy going and keep inflation from getting out of control.
I think that's a great perspective, though, of what you just brought up, Billy, of different parts of the country are seeing such different situations. We've kind of all inherently understood in East Tennessee we're in a really good spot here, but that is a hard thing, or at least on the surface would seem like a very difficult thing for the Fed to balance. Hey, before I let you go here, Billy, I would like to ask you, the President Biden just recently last week announced that he's reappointed Chairman Jerome Powell for another 3-year term with the Fed. The markets seem to initially like that announcement. Now, yesterday was another matter, but that was more, the markets more corrected went down because of concerns about the new Omicron variant of the COVID pandemic. But big picture, are you glad they reappointed Chairman Powell? I know the progressive wing of the Democratic Party wanted the other candidate who was kind of put underneath Powell right now. What do you think of the reappointment of Powell in these challenging times?
Jim, politics, I actually think it's a really good pick, because you've got folks on kind of both sides that don't like it. So that usually means it's probably pretty good. I think Powell is, I like him because he really is, as you watch him, he's not partisan at all. And in my opinion, and I think he is the right person to stay in that. I think the continuity is good. Today, he's been at these tables for the last several years. a very, very smart guy, and I like the pick. I think it will lead to more stability in our markets as we try to, as you say, as we kind of unwind this thing and look for ways kind of out and moving into the next sector of growth for our economy. So I like the pick. I thought it was a good one.
Yeah, I mean, when we're in the midst of all the challenges we've had, as long as things haven't really gone off the rails, consistency seems like a pretty wise thing. My final question is, there are still 3 open seats that will be filled in probably early December. And the fact that progressives didn't necessarily like the appointment of Powell, what do you think happens with those other 3 seats, and what does that really mean for the Fed?
It's really interesting. I think one of the reasons, and like I said, this is speculation, but we're in such a polarizing environment in Washington, and the current administration is trying to get a lot of things done, and I think they're trying to figure out which battles to pick. And I think that was one of the reasons they wanted to stay with Powell, is they knew that would probably be an easier confirmation. I think as these other open seats come up, I think you will see debate. If you have folks with kind of polarizing views, we're seeing it right now with an appointment that is they're vetting the new lead for the comptroller of the currency, which is one of the key banking regulators in the country. You're seeing debate over that because of certain views that are not moderate. So I think you'll see the administration be pretty look to try to create spots and put picks in there that will not be controversial, because I think at the end of the day they've got to figure out which battles to pick and which ones not to.
Yeah, a lot of wisdom in that comment. Billy Carroll, thank you so much for taking time out of your schedule and staying with us just about an extra 5 minutes here this morning. We really appreciate it.
Sounds great, Jim. Enjoyed it. Appreciate the time.
Yes, sir. That's Billy Carroll. He is the President and Chief Executive Officer of Smart Bank, as we've been discussing inflation and what's going on out there and what are the concerns moving forward and what is Federal Reserve policy likely to do. When we come back, 5 tips to beat inflation in 2022 and beyond in your financial plan and your investment planning. So stay with us. This is More Living with Jim Brogan. You're listening to News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. One thing I do want to mention, my next college class. So, we do some adult education in the community through the University of Tennessee and Pellissippi State through their adult education programs, non-credit. These classes are for people near retirement or in retirement. It's specifically about retirement planning. And one of the big things we talk about is how to beat inflation. That's one of your big enemies of retirement income. And my next class, I'm done for this calendar year. I'll be back at the University of Tennessee on February the 1st and the 8th. It's 2 2-hour sessions. It's at the Downtown Conference Center. There's free parking just right across the street, catty-cornered from the conference center. February 1st and 8th, 6:30 to 8:30 both nights. You can go to my website, broganfinancial.com, and click on classes, and you can click to learn more and to be notified when those classes go live for registration. Okay, let's talk about 5 tips to beat inflation as an investor, and more importantly, how you beat the impact of inflation on your life, which, financial planning is more about how you position your money to serve your life goals. For now, for retirement, and when you're gone. Many people, how they pass their financial assets on to their kids and their loved ones, or church or charity, is also very important. But how do you combat these risks of inflation? Our message there from Billy Carroll, President and CEO of Smart Bank, is that, don't, and I agree, don't be so worried that this is going to turn into the late 70s where we had such hyperinflation, at least not right now. But inflation is likely to be higher than it was pre-pandemic. Down the road, who knows? We've printed a lot of money. The Fed's got to unwind all that policy. And, if we see 3% inflation, just to put this in perspective, let's say you've got $1 million portfolio. Let's just use a round number. If we see 3% inflation, in 20 years, $1 million won't be worth what $1 million is worth now, right? It'll be worth, what would it be worth? A little less than $560,000. So in 20 years, the purchasing power of $1 million would be cut by over 40%. You know what? Let's look at it in income terms. If you need $80,000 a year to live on in retirement, and 20 years from now you're still drawing that same $80,000 a year, in today's terms, that's like living on $62,000, less than about $60,000, $60,000 to $62,000. No, I'm doing that math wrong. It'd be $80,000. I'm sorry, that'd be about $38,000. So think about how impactful that would be. If you need $80,000 today in income, that'd be like having $32,000 instead of $80,000. So, or it would. Man, I'm completely butchering this. That's what happens when you do math in your head instead of writing this down. It'd be a reduction of $32,000. So it'd be like drawing $48,000 in income. My apologies. So instead of 80, you'd be getting 48. That'd be a real problem. So 5 tips to beat inflation. Number 1, beware of bonds. And this is probably my number 1 tip. Traditional bond investment could be in my view, will be extremely problematic in the future. And the way bonds have been positioned in portfolios, bonds, for the most part, have had 2 reasons in a financial investment portfolio. One has been for income. Bonds pay regular dividends. You can live off the dividends. But, of course, interest rates are really low right now, so they're not yielding much. So the only way you can get any kind of return at all, any kind of yield on income on bonds, is to buy longer-term bonds. And then you're locking in today's low interest rates, which doesn't make a lot of sense. The second reason for bonds in an investment portfolio is to balance the risk of the stock market. In the short term, the stock market is completely unpredictable and volatile. We don't know what's going to happen over the next month, quarter, I would say year, 2, 3 years. The shorter term, the forecast, the more it's just an educated guess on what the stock market is going to do. And the market is volatile. So when the stocks are sharply going down, people are rushing to the safety of bonds. And so they help balance the volatility of the stock market. You don't lose as much typically when the stock market is sharply down, because in the short term, bonds help with that volatility. And that is still true, even with low interest rates. So yeah, bonds aren't paying much, but they do add some stability to a portfolio. The problem is, in an at-risk portfolio, we should still be invested for the future. I mean, even in a typical 60-40 or 70-30 stock and bond portfolio, I mean, you still should be investing with a 5 to 7 or 8 year investment horizon. In other words, you should be setting aside your risk investments and letting them grow and drawing your income from elsewhere, because we don't know in the short term what would happen. Well, if you're investing for 6, 7 years down the road, in that context, why would you want to have much in bonds or in bond funds? Because they're not, if interest rates stay low, they're not paying anything, or very, very little. And if interest rates go up, bonds are going to do even worse. I would say the long-term risk in bonds is actually higher risk than the long-term risk in stocks. Meaning, if you put $100,000 in U.S. stock in the U.S. stock market, And all you care about is what's it worth in 10 years, and what will it buy for you in 10 years as compared to today? Can it beat inflation? Because that's what we're talking about this week. How do you beat inflation? If you put $100,000 in stocks and $100,000 in bonds, which is at greater risk 10 years from today to lose value in terms of what you can buy? The bonds. There's no question in my mind the greater risk long term is the bonds. Yet so much of the traditional investment planning world still uses these heavy mixes of traditional bond investment that can go down that go down when interest rates go up. And we're on the front edge of what I feel like will be a bear market in bonds. So now you're in a little bit of a quandary. How do you get that short-term stability so you don't lose too much in the short term and yet get some long-term growth? So you have got to have a different kind of diversification. You've got to own other things that help stabilize a portfolio. Things like things that don't move with the stock market. Diversification means you got a whole bunch of stuff that doesn't just move up and down together. So if one thing zigs, another zags. So if one thing's way down like stocks, hopefully they're not all way down. And yes, traditional bonds has been the number one asset class that's used to balance the risk of the stock market. But you've got to have other things now. You've got to have things like commodities and energy and natural resources, and real estate is not highly correlated to the U.S. stock market. And then there are what I call non-traditional bond holdings that can go up with rising rates rather than down. I don't have time to unpack all that today, but they can go up when the markets, when interest rates go up instead of down. So there's just a lot of other ways to diversify a portfolio today. And the approach that's worked really for the last 50 years is just not going to work in the future. So beware of bonds. When we come back from our last break, we'll cover the other my other four key tips for beating inflation in 2022 and beyond. So stay with us as you're listening to More Living with Jim Brogan, only on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. We're talking about inflation and how to beat inflation. 5 tips for beating inflation in 2022 and beyond. By the way, I have a new guide out on retirement and inflation. And you can download that guide. It's complimentary. If you go to my website, go to broganfinancial.com, click on resources, and it's right there at the top. Retirement and inflation guide, what to know and how to prepare. I mentioned my first tip, which I spent a good bit of time on, beware of bonds. Let's quickly go through these last 4 tips. The next, or the 4 for this segment, the next is long-term growth is vital. You need growth over the long term to beat inflation. So at-risk investments are vital in a retirement portfolio so you can produce the kind of income you need 20 years from now to keep up with or beat inflation. And the only way you're going to do that is have growth investments, in my view. And the challenge with growth investments is that short-term volatility. So you have to create a financial plan that provides for some stability of income in the short term, but then growth of investments in the long term because of inflation. But long-term growth is vital. People are living longer and longer lives. An average 65-year-old married couple one of you is expected to live to 94 years old. So it's just vital. Tip number 3, provide for short-term stability of income. There's an expression, don't take a fixed income from a variable investment. You shouldn't be living on investments that go up and down in value every month and every week and every day, because inevitably they will be sharply down. And that means when they're down, you're having to sell off investments to generate income and then spend it, and you'll compound your losses. because that money's been spent. It'll never, ever come back. It's okay to sell something when it's down and reinvest, but you don't ever want to sell it and spend it when it's down. So you want to set aside money that's in some of these short-term, low-yielding things, banks, short-term bond alternatives. There's these things called guaranteed interest contracts, which are just like CDs, but they're with insurance companies instead of banks. This is the one part of your portfolio that'll have a hard time keeping up with inflation. So we don't want to put much in there. But what it does do is it provides for stability of income in the short term, so you can have your risk investments grow for the longer term to beat inflation. Tip number 4, balance the risk of your risk investments with greater diversification. And I talked about that when I was talking about being wary of bonds. You've got to have greater diversification, more things in your portfolio that if one thing zigs, another zags. That way, if one thing's way down like stocks, hopefully they're not all way down. And that's critically important because, having some stability in a portfolio in retirement for most retirees is pretty important. If you're 35 years old and you have a 401k, you're not worried about short-term volatility, because you've got a 25, maybe 30, 35-year investment horizon. It doesn't really matter what happens in the short term. But when you're retired, even when you position those risk investments for 6 or 7 years from now, you still got to be wary that you don't lose too much in the downturn, because it could take too long to recover and you may not make money. And what if we had 2 bear markets in the next 7 or 8 years? That could happen. I don't know if that'll happen, but it could. And your money wouldn't grow in the next 7 or 8 years to beat inflation if you lost too much in that big market downturn. So having greater diversification, where you're not just going up down with the stock market, that becomes more important when you don't have 30 years to wait for markets to work themselves out. All right, so greater diversification is key. And then my 5th tip on my 5 tips to beating inflation in the future is reduce your income taxes. Income taxes are the greatest expense you and I will ever have over our lifetimes. It dwarfs our medical costs. It dwarfs our costs that we pay for our housing. It is our income taxes. And income taxes are lower today than they will be in the future. Income taxes increase at the end of 2025 if Congress does nothing. However, with all of this spending and the federal debt we've been incurring, how likely is it income taxes increase more in the future? What will tax rates look like 10 years from now, 15 years from now? We have to be aware of that. And I think it's a pretty good likelihood they're going to be higher than they are even when the Tax Cuts and Jobs Act expires in 2020, at the end of 2025. Most retirees, you have more control of your income taxes in retirement than at any other time in your life. How you manage taxes leading up to retirement, how you manage taxes during retirement is as important or more important today in my view than it's ever been, because stocks and bonds are both expensive today. So I think there's a decent likelihood the next 10 years investment returns are not what they've been the last 10 years. And so remember, it's not how much you make, it's how much you get to keep. And if you can reduce the income tax side of that, you can put more money in your pocket. So those are my 5 tips for beating inflation in 2022 and beyond. You can get my retirement and inflation guide online. It's a complimentary download at broganfinancial.com. Click on resources. Thank you to Billy Carroll, our guest today, who's the president and CEO of Smart Bank. Thank you to Chris for engineering the show today. Thank you, Jill, for producing the show. You've been listening to More Living with Jim Brogan right here on News Talk 98.7 WOKI. We've been discussing your wealth, because greater wealth provides for more living so you can live the best years of your life your way. Have a great weekend.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.